So, I think the role of new companies focused on sustainability is very, very important for disrupting the historical way of doing business. So, if you look at businesses that have dominated the 20th century, they're not necessarily future proof for the 21st century. And we need new models to work on. Can you hear that in the back? So we need some new models which need to start from fresh, which are providing solutions for the world's biggest problems in the 21st century, not the 20th century. So I would urge entrepreneurs, innovators, investors to focus in on the growth markets of tomorrow, which are essentially enabling the economy to decarbonize and for us all to move to a more sustainable economic system. So the role of owners and governance is increasingly important. I think owners have a responsibility to invest along their values and should understand that their investment decisions and their ownership decisions have a ripple effect and a knock-on effect, not just within the organizations that they own, but across the whole financial system. My name's Colin le Duc. I'm a partner at Generation Investment Management in London. Yeah, so when we decide which companies we're going to invest in, we look at a number of different things. We look at the quality of management, we look at the quality of the business, and we look at the valuation of the company. So on the management quality side, we try and assess to what degree the company's management team is really focused on the long-term value creation and what the culture of the business is. So how are they treating their people, how are they dealing with their stakeholders, how are people incentivized, are all key aspects. When it comes to the business quality assessment, we look at the durability of competitive advantage. So we look at the financial return profile of the business, so typically focused on the return on capital employed, and we try and understand what that will look like over a very long period of time and how strongly the company can defend that return on capital. And then finally, we look at the valuation of the security. So we look at what price should we be paying for the kind of risk that we're taking by investing in the company. And that involves trying to understand the value of the company and trying to understand its future value. And if there is a gap between the current value and the future value that is sufficiently attractive, that's when we'll make an investment. How's that?